Hey, and welcome back to Lucid Equity, where we turn the confusing parts of money into one clear, simple move. Today we're going after something sneaky. The investing mistakes that don't even feel like mistakes. Here's the uncomfortable truth. You can pick decent investments, contribute every single month, do almost everything right, and still lose hundreds of thousands of dollars without ever noticing. Not to a crash, not to a scam, to 5 quiet mistakes that leak money in the background for decades. And here's the part that should get your attention. These are not beginner mistakes. Smart, disciplined, well-paid people make every one of them. Today, I'll show you all 5 with the real numbers and the exact fix for each. To keep it simple and fair, we'll follow one person the whole way through. Someone who invests $500 a month for 30 years, earning a reasonable 7%. Watch how much each mistake quietly takes from them. Mistake number 1. Paying fees you can't even see. Every fund charges an expense ratio, a small percentage skimmed off the top every single year. 1%. Sounds like nothing, right? Here's why it isn't. That 1% doesn't come out of your gains. It comes out of your entire balance. Every year, for as long as you invest, it quietly steals from the money that would have compounded, so the damage doesn't add up over time. It multiplies. Watch what it does. Our investor puts in $500 a month for 30 years, earning 7%. In a low-cost index fund that charges almost nothing, they end with about $604,000. In a fund charging just 1% a year, they end with about $502,000. Same contributions, same market, same everything. Except that one quiet percent ate $102,000. Over a longer career, that same fee can swallow a quarter of your entire final balance. The fix is almost insultingly simple. Check the expense ratio before you buy anything. Index funds today charge as little as 3 to 0.11%. The average active fund charges around 0.6%. And often far more once an advisor takes their cut on top. Pick low, and your future self simply keeps the difference. Mistake number 2. Trying to time the market. This is the one almost everyone tries, because it feels smart. You sense a crash coming, so you sell, and you wait to buy back at the bottom. The problem is that the market's best days and its worst days are neighbors. They cluster together, inside the same chaos. Step out to dodge the pain, and you almost always miss the violent rebound that follows it. J.P. Morgan ran the numbers. $10,000 in the S&P 500, left completely alone from 2002 to 2022, grew to about $62,000. But if you miss just the 10 best days across those 20 years, you ended with about $28,000, less than half. 10 days out of roughly 5,000. And here's the detail that should end the debate forever. 7 of those 10 best days happened within 2 weeks of the 10 worst days. The rebound hides inside the panic, and nobody, not the professionals, not the algorithms, not the loud voice on the internet, reliably calls the bottom. The fix? Don't try to. Stay invested, keep buying on a schedule, and let time do the work that timing simply can't. Mistake number 3. Waiting to start. This is the single most expensive mistake on the whole list, and it's the one that feels the most harmless. There is always a reason to start next month, after the raise, after the debt, after things settle down. But the real engine of investing was never the money. It's time. Every year you wait doesn't just delay your start. It deletes a full year of compounding from the far end, where the growth is biggest. Let's put a real price on it. Start at 25, invest $500 a month at 7% until 65, and you retire with about $1.3 million. Start at 35 instead. Just 10 years later, and you end with about $610,000. Read that again, because it's almost hard to believe. Waiting 10 years did not cost you 10 years of contributions. That's only $60,000. It cost you $700,000 in growth you can never get back. The early money matters most, because it has the most time to compound. So the fix is the simplest sentence in this whole video. Start now, with whatever amount you can, even if it feels too small to matter. A small amount invested early beats a large amount invested late. Every single time. Time is the one thing you can never buy back. Mistake number 4. Selling when it hurts. This is timing's evil twin, but this one is driven by pure emotion, not analysis. The market drops 30%. The headlines scream your account is bleeding red, and every instinct in your body says get out, protect what's left. So people sell near the bottom, then buy back in once it finally feels safe again, which is always higher. Buy high, sell low. On repeat. It's the exact opposite of the plan. And we can measure precisely what it costs. Every year, Morningstar compares the return of funds to the return investors actually earn in those same funds, and there is a gap. purely from when people choose to buy and sell. Over the 10 years ending in 2024, funds returned about 8.2% a year, but the average investor earned about 7%. A gap of 1.2% every year from bad timing alone. That may sound small, but on our 30-year investor, that gap quietly costs about $127,000. The crashes of 2020 and 2022 are exactly where it happens. The fix: automate everything. Set up automatic monthly investing, and then do not touch it during a crash. Boring, scheduled, emotionless investing beats a genius who panics every time. Mistake number 5, keeping too much in cash. This one is the most dangerous because it disguises itself as safety. Cash feels responsible. It can't crash. But sitting in cash is not the absence of risk. It's just a quieter risk. The slow, silent, absolutely guaranteed erosion of your money by inflation. $10,000 sitting in cash with 3% inflation is worth about $7,400 in real terms just 10 years later. You didn't lose the number on the screen. You lost its power to buy anything. And the opportunity cost is brutal. Our investor putting $500 a month into a savings account at 2% ends with about $246,000 over 30 years. The exact same money invested at 7% ends with about $610,000. Sitting in cash cost them roughly $364,000. Now, the fix is not zero cash. Keep an emergency fund. 3 to 6 months of expenses in a high-yield savings account where you can reach it fast. But money you genuinely won't touch for years should never be sitting still. Idle money isn't safe money. Put it to work. So let's add it all up. Fees, timing, waiting, panic, and cash. Now notice what every single one of these 5 mistakes has in common. None of them is about picking the right stock. Not one. They are all about behavior. The market is not what makes most people poor investors. Their own habits are. And honestly, that is the good news, because it means every one of these is completely within your control. Fixable for free, starting today. So here's the whole thing in one line. You don't beat the market by being smarter than everyone else. You beat it by refusing to sabotage yourself. Keep your fees low. Stay invested. Start early. Automate it. And don't let your cash quietly rot. Do those 5 simple things, and you will quietly outperform most investors who spend all day chasing the perfect pick. If this made investing feel a little simpler, subscribe. One confusing money topic made clear every single week. And be honest with me in the comments. Which of these 5 have you been guilty of? I've done at least 2 of them myself. This video is for educational purposes only and is not financial advice. All returns here are long-run averages, not guarantees, and your own results will vary. Do your own research or talk to a licensed professional. So if this helped, do 3 quick things. Hit that like button. Share it with someone who's leaving money on the table, and subscribe for a new money breakdown every single week.